CGTN, Beijing.
It's the world's biggest e-commerce giant, and Alibaba has been giving more details of its plan to split the business into 6 separate units. It made the surprise announcement earlier this week, saying it wanted to unlock shareholder value. Well, our correspondent Catherine Drew has been following the story. Catherine.
That's right, Jamie. Robin, well, senior executives have been discussing the plans with investors, hoping to offer reassurance about what some are calling the baby Babas. Well, let's take a closer look. The 6 units break down into e-commerce, cloud computing, local services, international commerce, digital media and entertainment, and logistics. The Alibaba Group will retain control through a holding company structure, but with new management for each unit. And as we heard earlier in the week, the plan is to allow these units to raise capital and potentially offer IPOs when they're ready. But the 6 are not equal. The e-commerce unit, the only one that Alibaba will retain sole ownership of, generated more profit in the last fiscal year than the whole group. But the local services and digital commerce units were struggling to make a profit in the December quarter. So why is Alibaba doing this now? Well, CEO Daniel Zhang says it's to make sure the business, which currently employs 240,000 people, to make them more agile, enhance their decision-making and respond faster to market changes. This means the sectors that are struggling can make changes more quickly, but crucially, they won't have the support of the profitable units. After that call with investors, Alibaba shares in Hong Kong rose nearly 3% before shedding some of those gains to end the day up around 2.5%. Shares in New York are currently up just under 4%, having seen a 12% rise on Wednesday. Now, the Alibaba Group CEO Daniel Zhang says preparations will begin immediately. One to watch could be the logistics arm, Chanyao. Reports say it's planning to be the first of the 6 units to go public, listing in Hong Kong before the end of the year. It's currently valued at $20 billion. Back to you.
Catherine, thank you very much. Catherine Drew, our correspondent there. Let's talk now to Jim Osman, the founder of the Edge Group, which specialises in analysis of spin-offs. Jim, good to see you. Welcome. So Alibaba's boss saying the changes to this company will make it more agile. How might that be achieved?
Well, see, here's the thing, Jamie. I have no issue with the value creation, okay? The premise that the sum of the parts is greater than the whole sometimes plays out in some of these big companies, right? And that's what they're aiming to do. They're basically saying, we have this super company, but actually it's not performing. I mean, even if you look at the growth rate over the last, from 17 to 22, Alibaba grew at 40% CAGR. And actually, but that was never translated into its stock price. So over 5 years, you're still sitting on a loss of around 12% with the S&P up 11%. So they had to do something. Now, my problem is, again, not the value creation. My problem is how they're going about it. Now, the message to investors here really is quite clear. It's an IPO. They're going to IPO the units. Now, I have a problem with IPOs. Why? Because they're manufactured investments. Let me give you a statistic here. And tell you how manufactured they are. I'll give some statistics from the US over here, but it's pretty much similar around the world. The share of companies in the United States were profitable after the IPO has just been decreasing year on year, from a peak of 81% in 2009 to 28% of companies profitable after IPO last year. So you can see the edge on IPOs when investors get excited is just diminishing, because the marketing is geared to sell you in an investment. Now, that can't be a good thing. Valuations always aimed at the higher end of the range. You've seen IPOs go through like Uber. Uber, the last time it saw its higher share price was on its IPO. So, they have one price, they have expiring lockouts, and just realise the investment is designed to benefit the seller. So it's a two-edged sword for investors right here. So to answer your question, yes, it creates value, but actually the way they're doing it might not be the best case.
Jim, briefly, you analyse spin-offs for a living. Which ones have historically been most successful?
Absolutely. So we've seen Carrier from Raytheon Technology, been a huge performer, three-way split. Electrolux, where you guys over there spun off their washing machines and things like commercial appliances. Huge one-year return, 150%. Return a day, about 200%. And also a spin-off from Metso as well. But, you know, spin-offs provide more value than IPOs. That's the message, really, Jamie, here for investors. And they should be looking at ones coming up like Kellogg, GE Renewable Energy, and Johnson & Johnson, rather than looking at more manufacturing investments like the Alibaba IPO.
Well, we're talking about Alibaba. I mean, maybe there'll be a stampede now. And which other big tech companies do you think might perhaps benefit from spinning off their divisions?
And that's a great point. You've got companies like Meta, you know, series of business. I mean, Instagram, not even monetized. WhatsApp, look at the amount of people using WhatsApp, not monetized. These are all hidden value within companies that they could potentially spin off. And I believe they will break up because there's a two-edged sword here. There's one where companies have to create value in this environment, but two, also the move by governments and authorities to actually protect your privacy and make sure companies are transparent. So you've got Meta, that people should look at. Amazon is a great one in terms of their cloud business, and even Google. So the FANGs, expect those to be broken up very soon. And that's a good margin of safety for investors who want to buy those stocks.
Jim, good to see you. Thanks for your expertise. Jim Osman, founder of